Hello, everyone. I'm Meher Walia, and welcome to Finding Finance, the podcast where we delve into the different subfields of finance. This podcast aims to help high schoolers who are contemplating a career in finance understand the different paths in the world of finance and help them find which path interests them the most. Our esteemed guest today is Maulin Shah. Mr. Shah is the co-founder of Digital Strategy. Prior to this, he had a stellar career as a portfolio manager for several years at the most renowned hedge funds in the world, such as Citadel and more recently, Millennium Management. Our conversation today will focus on alternative investments and hedge funds. I hope you enjoy our conversation with Mr. Shah. Mr. Shah, thank you for joining us today. It is a pleasure to have you on the show.
Thanks for having me. I appreciate it.
Perfect. Let's start at the very beginning. Take me all the way back to your upbringing. What was life like for you growing up? Where did you grow up, and what were your favorite subjects in school?
Yeah, absolutely. So I actually grew up in Manhattan, in New York City. Went to public schools, went to PS59 in Midtown East, Wagner Junior High School, and then ultimately Bronx High School Science for high school. And after that, I actually went to NYU, so I'm a straight-up New York City kid. But life for me growing up, I come from humble beginnings. My dad went to Columbia University. He came here from India to study, to be a pharmacist. But ultimately, he gave up that profession and opened up a bunch of convenience stores, which was obviously very different than what his education was all about. But I grew up basically working in the store. So since I can recollect, probably like age of 6, I've been working in the stores, making newspapers, showing up on the weekends, helping my parents whenever they needed something. Also, I have an identical twin brother, so both of us were basically very, very focused on making sure, we're helpful and able to contribute to our family. But yeah, so my favorite subjects, I didn't really know what I wanted to do. Ultimately, I went to the Bronx High School Science. I thought I wanted to go into science. My identical twin brother went to Stuyvesant, and he also thought he was going to go into science. But what was interesting is that growing up in the store, we saw a lot of different types of individuals coming in, from doctors to lawyers to folks in finance. And when they see young kids working in the store, they ask questions and, what do you want to do when you grow up? And, I had exposure to a lot of different types of people. And I realized early on that I was really fascinated by finance. I would ask questions as to what they did, how it differed from other areas. And ultimately I realized that that's what I wanted to do pretty early on, just based on that exposure that I got at the store, which is interesting. And because I grew up in the city, I think, it was very diversified, I would say. I was actually a Boy Scout as well, ultimately an Eagle Scout. And so a lot of my peers, a lot of the students that were in the Boy Scout troop also had parents that did various different things. So I had exposure to a lot of different sort of professions early on because of the fact that I grew up in the city, which is I guess unique, I would say, to a certain extent, versus growing up in a suburb where everyone kind of does the same thing, for example.
Working at the convenience store that young must have been a great avenue to learning about so many different things in the world.
So many different things, and actually getting exposure to folks in all walks of life, right? From the folks that are doing construction to the actual professionals, and interacting and being in that environment, getting that work ethic in really early. It taught me everything, to be honest. Like, by the time I was in high school or college, that work ethic was in me at the end of the day. So it was definitely a unique experience, I would say.
Did you have any other favorite hobbies while you were younger?
Yeah, absolutely. So, like I said, I spent a lot of my time on Boy Scouts, ultimately Eagle Scout. I ran track while I was in high school. So I did indoor, outdoor, and cross country. And then basically just study. So that kept me pretty busy.
Yes, it must have. You mentioned for undergraduate school, you attended New York University's Stern School of Business, dual majoring in finance and information systems. What was business school like? And how did business school help you on your path to finance?
Yeah, definitely. Look, I think it's interesting. People always ask younger students, hey, what do you want to do when you grow up? The reality is nobody really knows, right? So you just want to put yourself in a position where you get exposure to a ton of things. So NYU was great because not only did I attend the business school, but I also had the opportunity to basically pursue internships while I was there. So initially, I thought I was going to be a trader in trading basically fixed income securities. And that's kind of what I did while I was at NYU. I worked for JP Morgan in middle office, then Morgan Stanley in the front office, and ultimately my summer internship, my junior year, I was at UBS on the interest rate derivatives desk for the summer. So up until that point, I thought I was basically going to be a trader. But because I went to the undergrad business school, I had exposure to all the different areas within finance. And so by the time I graduated, I realized that trading wasn't something that I wanted to do. I just wasn't something that I thought it was interesting. I thought I was built for it. I liked the fast-paced nature of it, but I was really fascinated by businesses and learning about how companies operate, how to interact with management teams, how to due diligence on the individual companies, how to think about valuation, how to think about the competitive landscape. That to me was just a lot more interesting. And as a result, when I graduated, I only applied for investment banking positions. So ultimately, I totally pivoted. I ended up going to UBS, specifically focused on leverage finance.
I mean, New York City is the financial capital of the world, so no better place to get internships and exposure to.
Absolutely.
Finance.
I mean, that's also a huge competitive advantage, right? I mean, I think you're young. I wouldn't wait till the very end to pursue internships or to start networking. I think the earlier you start, the better off you'll be ultimately. Just having that exposure at such a young age gave me a lot of conviction after I graduated. Conviction surrounding exactly what area of finance I wanted to pursue. And it's interesting because, like I mentioned, I have an identical twin brother. He actually went into mortgage trading. So we went in totally different areas of finance, and he loves what he does. But he figured it out early on, and same with me. I kind of figured out that I wanted to pursue something very different.
How did dual majoring help you later in your career?
Yeah, absolutely. So it actually helped me very early on, to be honest, and then ultimately down the line. So getting an internship is the most difficult thing, right? Because these employers want you to have experience, but you're still young and you don't have that experience, right? So you need to sort of differentiate yourself. And so that's where information systems, which is essentially, similar to comp sci, was very helpful because my first internship was at JP Morgan when I was a sophomore, and it was a middle office opportunity where the department was essentially creating reports for the trading desks on a regular basis with P&L settlements, things of that nature. But it was very tedious. It took basically half the day to generate those reports. Because of the fact that I knew how to program, I basically spent my first 2 weeks writing code, and then we basically automated it, so it took like 10 minutes. So that was my edge, right? So that's something that I highly recommend students sort of pursue. You need to figure out how you can add value, because ultimately, that's how you secure the best opportunities. That's how you get noticed. That's how you get to expand your network. That's how you get incremental opportunities. So doing both things actually differentiated me and really gave me a competitive advantage. And then just moving forward, like I mentioned, when I got that internship at UBS, which was a highly coveted internship, I was on the interest rate derivatives desk, but I was working for the quant. So I was literally, because they weren't going to allow me to trade, right? Mm-hmm. I could have mirrored someone and just sat there all day long. Instead, I was working with the quant and just coding the entire summer. So just having that dual skill set is helpful. It doesn't need to be information systems or comp sci or anything, but just having a sort of a different perspective in addition to focusing on, let's say, finance is definitely value add.
And as you mentioned, in 2000, you were in investment banking at UBS out of college. What is investment banking, and what did your days entail?
Yeah, absolutely. So I got placed within the leverage finance group, and that specifically means we're targeting or we're banking companies that are highly levered, companies that are triple B or below in terms of ratings. And so it was fascinating because instead of focusing on a specific industry, I was a generalist. So I worked with tech companies, industrial companies, you name it, right? So it was a great experience because every day was different, or every project was different. I was just learning about different businesses, and while I was there, we were trying to help them raise capital for financing mergers. I worked on LBOs. Ultimately, I worked on IPOs, mergers, convertible bond offerings, but basically any sort of strategic need that a corporation had, we were there to help them. But they were specifically focused within the leverage finance sort of universe. So it was a very unique experience. My day-to-day, so obviously it's quite intense. I spent, literally 80 to 100 hours a week working, and that's like literally 80 to 100 hours a week. It was no joke. Many nights sleeping underneath the desks while I waited for the printers to come out with the pitch books. But like, it was a great experience because not only did I get a chance to learn how to pitch, meaning create presentations, I got a chance to go on the road and actually interact with CEOs and management teams and explain to them, what our views are as to what they should be doing to further enhance their business, whether it's changing their capital structure, whether it's strategically pursuing other investment or acquisition opportunities, or whether it's to divest businesses. But you really understand through that experience how companies operate, how industries operate, what differentiates one versus the other, what gives a company competitive advantages versus disadvantages. It's a great, I would say, experience early on coming out of school. And then ultimately, as you get, more experience, ideally you'll have a lot of deals that you work on, and that's the fun part, right? Like actually not just pitching, but actually working on real live deals and actually seeing it go through, and seeing on TV that your acquisition was announced or your divestiture was announced. I mean, it's at a young age, it's really fulfilling. It's a lot of hard work, but I definitely recommend it if you're interested in that line of business.
You mentioned leverage finance and IPOs and LBOs. Do you mind just giving a brief overview of what those are?
Yeah, for sure. So, like I said, leverage finance business are typically companies that have more leverage, right? So their balance sheets are a little bit, different than like investment grade company. So leverage buyout example would be I own a business. Let's say I don't feel like the markets are valuing the business appropriately. I think it's worth a lot more than what the stock market is kind of saying. And as a result, I want to take the company private. So then what I would do is I would go into the leverage finance markets. I'd raise a ton of debt. I'd make an offer for my company and try to take it private so that I can wholly own it at the end of the day. So that'd be an example of an LBO. Oftentimes it could be management-led. And oftentimes it could be sponsor-led. Sponsor meaning like private equity shops, companies that are really focused on buying actual businesses, cutting costs, turning them around, and potentially selling them down the line, or IPOing. And IPO basically means going public. So if you're a private company and you want to be listed on the New York Stock Exchange or NASDAQ or any exchange overseas, you go through this whole process called an S1 process, ultimately an S4 process, and you go public. You raise capital through issuance of equity, stock, and you use that capital for growth. And ultimately, as you mature, you can issue more stock for acquisitions, for growth, for CapEx. But it just gives you access to permanent capital. It's just another vehicle to basically raise capital to fund your business.
I see. And after UBS, you joined Polygon Global Managers as a portfolio manager and analyst. What did your role entail there?
Yeah, absolutely. So at that point, I was an investment banker for 4 years, and I was trying to figure out, is this something that I want to pursue for the rest of my career, or do I want to pivot? At that point, I did want to pivot. 4 years was a lot, I'd say. And so at that point, I was deciding, do I go pursue a career within the hedge fund industry, or do I pursue a career within private equity? And I really was just very excited and interested in the public markets and investing. And so that's why ultimately I decided to pursue a career within the hedge fund universe. So I went through, obviously a round of interviews with a bunch of hedge funds, and ultimately I joined Polygon Investment Partners. Polygon was started by an ex-Citadel partner who was the head of event-driven equities at Citadel, and he had started. So it was one of the largest launches of that era. And ultimately, Polygon ended up being, like a $14 billion hedge fund. I started there as a junior analyst. Essentially, I knew nothing about hedge funds, but I did have a very strong background, and I was very passionate about the public markets. And so I wanted to add value day one. And so it was intense. They threw me in the fire. Ultimately, my job was to analyze businesses that were publicly traded, figure out if I thought they were cheap or expensive, determine whether or not we should be buying, selling, or shorting. And ultimately, because it was founded by an individual who was focused on event-driven, that was the mandate that we all had at the hedge fund. The event-driven universe basically is focused on situations that can either create or destroy value. So think of spin-offs, litigation, regulatory change, mergers, bankruptcies, any sort of event that can either create or destroy value. So stuff that a lot of folks are sort of afraid to jump into. Typically, these situations are a little bit more complex, requires a lot of incremental work, including hiring advisors, attorneys, folks that can really help you get a competitive advantage relative to sort of the regular standard, investment analyst on the street. So it was a great experience for me. Look, I started off as an analyst, but ultimately, because of my investment banking experience, I really understood how companies operate. So I actually led 2 activist campaigns. Activism basically means look at a company, you think they're not operating the way they should be, you get vocal, start issuing letters publicly, and ultimately try to affect change. And so that was a great experience for me. I pursued 2 companies. One was a home builder, another was a tech company. We were successful on the home builder side. On the tech side, we ultimately had a settlement. But because of my ideas, I got promoted to a portfolio manager at a very young age. So my advice to you is look, you can't be overly confident when you're starting off, but if you do have strong views and you're able to express your views in a concise, tactful manner to your bosses, they will listen. Ultimately, everyone in this business, especially the hedge fund world, is there to make money. So if you have good ideas and you can express why these ideas will ultimately make money for the firm, they will support you. And that was great for me because I wasn't afraid to express my thoughts and I wasn't shy about it. And lucky for me, I had a boss who was supportive and he wanted to see young individuals thrive. And so the firm put their resources behind me, and it was a great experience for me.
Yeah, so if you have an idea, don't be tame or shy about expressing it.
Exactly. I mean, look, at the end of the day, you want to learn as much as possible, right? And that's what you have to do earlier on in your career. You want to network. You want to have great mentors. You want to learn from them. You want to figure out what your companies or your employer is looking to achieve, and how you can add value. And once you figure that out, for sure, you can't be afraid to express your views and thoughts.
So let's dive into the world of alternative investments,
Yep.
Core elements of hedge funds. What are short event-driven equities, and how do they work, and why do investors use them?
For sure. Look, shorting is an interesting, controversial sort of concept. So basically, when you buy a stock and you hold it, obviously you want the stock to go up so that you can make money, right? But oftentimes there are situations in the public markets where stocks are overvalued for various reasons. It could be because the market's not paying attention, or the market believes that the executive management team will be able to execute on a concept, and you just disagree, right? Because you see something else in the marketplace from a competitive standpoint, or you believe that their projections or the ambitions are too great relative to what you think will actually happen. In those instances, you short a stock. So that basically means that you want the stock to go down. And so it's an important part of the marketplace because it keeps everything sort of balanced, I would say, right? It helps identify potential frauds. It helps identify issues in the marketplace. It helps identify management teams that are not being unnecessarily transparent. So it's just an act of basically keeping everything in balance. So for hedge funds specifically, they often run long and short versus a typical like a mutual fund, which is essentially long only for the most part, and they typically try to benchmark themselves against an index. So they'll say, okay, we'll benchmark ourselves against the S&P 500, but we'll be overweight or underweight certain sectors, and over time we want to beat that index, and that's how they kind of make money. And so that's a more dominant percentage of the market. Alternatives delve into all these other areas, right? Whether it's hedge funds, private equity, venture capital, long short strategies, commodities, macro, systematic strategies, which basically means quantitative strategies that are machine driven, things that aren't as standard as just buying a specific stock. And so those strategies are important as well because alternatives typically are expected to, not always, they don't actually, but they're expected to generate better risk-adjusted returns. So theoretically, if you have a good manager, they should be able to lower the risk profile, the volatility compared to the overall market, and they should be more consistent with their return profile. And so shorting comes into play there, right? Because if you're thinking about just being long, long meaning just buying a stock and holding it, and then you see a situation like a COVID or you see a market crash, ultimately you're gonna lose a lot of money, right? But if you actually have short positions where you're betting on some of these names to go down, that'll balance out the portfolio, that'll lower the volatility, and hopefully, generate a better risk-adjusted return for the investors. So you're seeing a lot of endowment funds, pension funds allocating a certain percentage of their assets to alternative investments as a result.
So it's like the opposite of traditional investing, where you're trying to see if a company will lose value and betting against that.
Yeah, exactly. I mean, it's like I said, it's a way to be a positive and negative on specific names, sectors, or even security types, right? So this is not just stocks; it could be macro, meaning you could be betting on commodities like oil, gas, cotton. It could be anything at the end of the day. And those decisions are based on macro factors, based on company specific factors, based on sector, based on geopolitical events, based on things like viruses, like COVID, for example, right? Like there's always a company or a sector that wins or loses based on what's happening in the world. And the alternative investment world tries to take advantage of those discrepancies.
What are long event-driven equities?
Yeah.
How do these work, and why do investors use them?
Yeah, for sure. So I spend more of my time on those kind of opportunities, and so I'll give you examples. I'd say throughout my career, there have been different themes, but we're trying to find situations where an event can create or destroy value. Typically, the marketplace sometimes is not focused on sort of the levers that a company can sort of pursue, or pull on to create that value. So I'll give you an example. If a company has multiple businesses and the market's not valuing the different individual businesses on a sum of the parts basis, and it's just looking at it holistically, they might miss the fact that one of their divisions is growing, fivefold relative to the others. In those instances, the company should spin off that business so the marketplace actually appreciates the true value of the business. Or they can sell it. They can divest it. They can ultimately, pursue that strategy more aggressively and invest more capital to see if they can extract more value. There have been other themes, like, for example, in my career, like the REIT theme was really interesting. So there were a lot of companies within the stock market that had a lot of real estate holdings that the marketplace didn't fully appreciate or realize like how valuable they were. And so there was a whole theme where many of these companies were basically converting to REITs or monetizing their real estate or doing sale-leaseback transactions, so that the marketplace can realize, hey, wow, there's all this stuff in here that we don't really fully appreciate. And so, like management turnover is another one. Oftentimes there's litigation, big lawsuits that are happening that people aren't fully appreciating. But hey, if the lawsuit comes in favor of the company, that could create a significant amount of value, right? So events that aren't necessarily fully being appreciated by the marketplace that can create a lot of value, those are the kind of opportunities that we focused on.
What is the overall difference between shorting and longing a security?
Yeah, it's basically, look, it could be for reasons like we discussed. You believe that company's worth more or worth less. It could be for hedging purposes because you want to minimize the volatility in the overall marketplace. So, for example, let's say I like Apple stock, but I am nervous about the overall macro environment and the consumer spending. But I really believe that Apple is going to relatively do much better. So theoretically, I can buy an Apple stock, buy the Apple stock, and short consumer discretionary stocks, not because of a negative view on those stocks, but just because I'm nervous about the overall macro picture. But on a relative basis, Apple, I believe, should outperform. So that's how you can, use it for hedging purposes. many of these hedge funds are actually market neutral as well nowadays, meaning they don't want to focus on beta meaning whether or not the markets can go up or down. They solely want to focus on whether or not they can capture alpha, which is tied to the specific stocks. And as a result, for every dollar they buy a stock, go long, they'll actually spend a dollar to short a stock. So they're basically market neutral. And the way the hedge fund would work and make money is if they're right on their longs and shorts on a relative basis.
So minimizing that risk by having one that'll go long, one short. In that sense.
Exactly. And look, and it gets even a lot more complicated than that, but that's the gist of it. But now the markets have gotten so sophisticated that they can actually break down the factors that actually move these stocks. Factors could include volatility, value, momentum, rates, short interest. And so now a lot of these hedge funds have the ability to break down all those factors, and they can say, okay, look, I have way too much volatility in my portfolio tied to these specific names. I need to minimize that. So even though I'm market neutral, I'm balanced, long and short, I just have too much volatility as a factor in my portfolio, and I can actually tweak the portfolio to balance that out to a level that makes me more comfortable. And factors also include, industry exposure. Like just because I'm long and short, that doesn't mean I'm not offsetting the industry exposure. And that could be, for example, if I'm long tech and short healthcare, right? There are different levels of risk embedded within that kind of portfolio. And so the whole factor concepts become very, very relevant. And oftentimes you see markets move purely based on factor unwinds. And whether it's because the hedge funds are doing it, whether it's the actual fundamental investors, the quant funds, it's gotten a lot more sophisticated, to say the least.
Mm-hmm. And how is event-driven investing different from just traditional long-short equity investing?
For sure. So like I said, the markets have moved dramatically. So historically, I would say a lot of these hedge funds were like generalists. They'd hire a bunch of analysts. Each analyst kind of focused on a sector, and then they'd move the money around depending on where they saw the opportunities. Now you've seen over the last, I'd say, decade or so, these behemoths, these large multi-manager shops like a Citadel, Millennium, Balyasny. What they're doing is they're actually creating teams that are solely focused on individual sectors. And then I'm talking specifically about the long-short equity business. So you'll have a portfolio manager. He or she will hire 5 to 10 analysts. Each analyst has a coverage universe. They'll focus on just 40 names. That's it. And they'll have a very strong view on those 40 names. And so these are basically subsectors within a sector. So for example, if it's consumer, you'd have consumer discretionary, you'd have staples, you'd have retail, you can have restaurants. But the analyst will focus on, let's say, 40 names within those sectors. And they'll have a view at any one point in time how many names they want to be long, let's say 10 longs and 10 shorts. And they'll consistently, constantly move those around depending on the market changes. But that's very different than event driven, right? Because what they're doing is they're becoming experts on these companies, and they're making a bet on the earnings, the quarterly earnings, whether or not the companies will actually meet, beat, or exceed expectations. And that will determine whether they want to be long or short. They're having a very strong view on the actual overall sectors, and they'll determine which ones they want to be long or short. And so it's a very different, unique sort of skill set. The view behind that model is that if you dedicate all these resources to specific subsectors, theoretically you should have an advantage over the generalist. And so you're seeing a lot of the larger hedge funds move towards this kind of model. And also by being, market neutral, meaning long and short, they can minimize the volatility. And as a result, they can actually add more leverage. More leverage basically means they can borrow money and basically increase the position sizes, right? So for example, if I'm a $1 billion hedge fund, I can actually have $3 or $4 billion of exposure. That sounds scary because it's leverage, but having said that, they have a lot of shorts. So as a result, if the market does go down, it should offset the volatility. And so you're seeing a lot of models shift towards that concept more recently. I'd say over the past decade or so. You aren't seeing as many funds that are sort of generalist or even single manager funds. You're seeing very few of those. You're seeing a lot of capital being allocated towards these multi-manager sort of profiles.
So just a lot of advantages towards event-driven strategies in terms of risk and analyzing different factors compared to just traditional long-short equity investing.
Yeah, correct. It's definitely a different skill set, I would say. And look, it really depends. Like if you are really excited and interested in a specific sector, for example, like you really love tech and you really want to be an expert within that AI vertical, like you should go for that, right? You really love healthcare, you should pursue that. I think the world definitely rewards expertise, I would say, right? So you want to have some area of expertise, whether it's like focused on event-driven strategies. So you're really understand how to delve into legal documents and understand how these things impact stocks. Whether it's like mergers and you want to focus on M&A, or whether it's a specific sector, you need expertise, and there are many opportunities within the alternative investments universe for you to pursue that. And that doesn't include stocks. That includes commodities. It can include rates. It could include bonds. There are a lot of different areas within that universe that you can pursue.
What is special situations investing? And what qualifies as a special situation?
Yeah. I mean, special situations, I think people often use that along with event-driven. I think it's very similar. More often, the special situations also includes other products. So event-driven equities is obviously equity-focused. Special situation hedge funds also focus on event-driven situations or quote-unquote special situations, but they'll also look at other parts of the capital structure. So they'll look at debt, they'll look at private equity, they'll look at other areas within the capital structure to figure out whether or not they can make money. So I'll give you an example, like a special situations fund, that's also focused on all these event-driven situations we talked about, may actually go long a high yield bond, but they can short the equities in the same company, right? So it's like a different way of trying to capitalize on the mispriced opportunities within the marketplace, because they believe that the credit markets and the equity markets aren't valuing these businesses appropriately. So, for example, the equity market is believing that the company has an amazing, robust growth profile, yet the high yield market is not appreciating that. And they don't appreciate the fact that if this company does execute on their equity strategy, then ultimately their cost of borrowing will go down and these bonds will trade up materially, right? So it's identifying discrepancies within all markets across the capital structure.
Mm-hmm. I see. Let's shift to merger arbitrage. Yep. What is a merger?
Yeah, absolutely. So merger in its most simplistic form is when one company buys another, or they both decide to combine. And so I spent a lot of my career focusing on merger arbitrage as well. And typically the arbitrage portion of mergers is tied to the fact that a merger typically takes a certain amount of time to actually close as they go through the regulatory approval processes, right? So I'd say historically, if it's not a complex transaction, it can get done within, let's say, 3 to 6 months. And if it's super complex, it could take years. But while you're waiting for the merger to close, the stocks will trade at a discount. So, for example, if company A were to buy company B for $100, and our view is that it's going to take a year to close, it's going to trade at a discount to the $100. And that's purely based on the time value of money, right? Basically, if it traded at $100, you wouldn't buy the stock. But if it's trading at $94, you might, right? Because you can make $6 over that 1 year period. And so that's what that arbitrage portion is focused on, capturing the spread between what you'll ultimately get and where the stock is trading. And the spreads will be wide depending on the timing, the amount of regulatory risk associated with it, the complexities surrounding shareholder votes and the dynamics there, whether or not it's going to be easy shareholder approval or not. Also tied to the merger agreement itself, like how many conditions are there, what are the outs. So for example, like if it's a merger within a oil and gas industry, and in the merger agreement, there's no condition tied to the commodity prices, that's great. But what if there's a out that says, hey, if commodity prices drop by 15%, then the buyer has a right to walk away? Well, that obviously introduces a significant level of risk, right? And so it's really looking at a merger and analyzing all the different aspects associated with it that can either increase your confidence level that the merger will close, or increase your confidence level that it will not. and that'll determine whether or not you want to go long, meaning buy the stock, or go short because you think the deal will actually break.
Oh, I see. And then what is just arbitrage in general?
Yeah, arbitrage is basically taking advantage of a discrepancy, right? It's basically, in this most simplistic form, it's saying, okay, look, there's an opportunity in the marketplace that exists, and it's mispriced, and it's an arbitrage opportunity for me to take advantage of. And that could be within mergers. It could be convertible arbitrage. It could be rate arbitrage. But it's basically just focusing on a mispriced discrepancy in the marketplace, and taking advantage of it so that you can close that gap.
So merger arbitrage is just assessing a company, but between the time they announce they want to merge and the actual date the deal closed, and see whether you think they'll actually close or not, and long or shorting based on that.
Exactly. So when you look at this opportunity, you'll say, okay, I believe there is, based on all my analysis, there's a 95% probability of this deal closing. The market is assigning 75% because they're really nervous about this specific regulatory requirement. Let's say it's a China approval that's necessary. The geopolitical environment is dicey between the US and China. Even though this deal should get done, because of the tensions, China may just not approve this deal, right? And so the market is now assigning only a 75% probability. In that instance, you're going to do a lot of work. You're going to hire a lot of consultants. You're going to try to understand which agency in China is going to be responsible for this, who's actually going to be approving this, what are the companies doing to give the regulators comfort that this will actually get done. If I feel really comfortable and I believe 95% probability of success, market's at 75, I will buy that stock.
How do you secure merger arbitrage deals?
Yeah, so typically it's so there's two ways of doing it, right? There's announced mergers, right? So you'll see that in the newspaper, right? You'll see it on the news. You'll see it in a press release, and there's also like pre-merger situations where it could be rumors, it could be news articles saying, "Hey, company A and company B are currently in talks to potentially merge. The deal has not been negotiated." But they're going through the process, right? So that'd be, obviously, in that instance, there's a lot of risk, right? Because deals can always fall apart. And obviously the discount to whatever the fair value might be is going to be significantly greater. You might not know the terms. You may know the terms based on what's in the press reports. And there's other opportunities where you just think something should happen. Like it's just logically and strategically just so obvious to you. Those are the three different buckets, and you'll size the positions differently in each one of those buckets, right? Because your conviction level is going to be significantly different. So obviously, if it's an announced merger and it's definitive, you have a merger agreement, it's likely going to happen, right? So you're going to have a lot more confidence in having a much larger position because your conviction level is higher. If it's just an article in the newspaper, things can fall apart. You'll size that position much smaller. If it's just based on your logic, you'll potentially be market neutral. Like you'll hedge out all the industry risk and you'll wait for it, right? So like you'll size those positions. You'll think about the risks associated with those from a hedging perspective very differently.
You were a portfolio manager for some of the best hedge funds in the world, such as Citadel and Millennium Investments. What is a hedge fund?
Yeah. Hedge fund is another alternative investment vehicle, right? Ultimately, they're promising that they're going to generate better risk-adjusted returns. And so the hedge fund strategies can include, like we discussed, long-short equities, event-driven strategies, high-yield strategies, high-yield meaning focusing on high-yield bonds, distressed strategies, meaning focusing on companies that are either going into bankruptcy, in bankruptcy, or on securities that are trading at deep discounts. There are macro strategies, meaning like these investors, portfolio managers will focus on the geopolitical environment. They'll focus on their views on commodities. So, for example, today, the U.S. just invaded Venezuela, right? Like, do we have a view on oil as a result? There's risk that we're potentially going to attack Iran. What does that mean for oil? So macro investors will do that. Others will focus on rates, right? So their views on what's going to happen with interest rates across the globe. Others can focus on currencies. So there's all these different securities that hedge funds will focus on in different markets. And ultimately, depending on their strategy, they'll be long short. They'll have more of a long bias. They'll be market neutral. Some hedge funds are just short only, just short bias. And so there's a lot of iterations tied to the hedge funds, but ultimately they're giving the investor another option that's not just focused on long only.
So hedge funds can differ on the type of investments they pursue.
Exactly. And many of them have niches, right? Like they could be industry focused also, right? And some of them just focus on little things. They can focus on like trade claims. They can focus just on litigation. Like there's so many different niche concepts within the hedge fund universe. They're all just trying to basically focus on this arbitrage opportunity and trying to gain expertise above and beyond what the general public or general institutional investor is focused on.
Who invests in hedge funds and why do they do so?
Yeah, absolutely. So look, it depends on the size, but I'd say, as you mentioned, I've worked for some of the largest hedge funds, blue chip hedge funds, over the past 20 years. And as a result, all the hedge funds that I worked at have been, $10 billion plus. I've managed, $1 to, $6 billion myself, depending on the hedge fund that I've worked at. I would say they're all, for the most part, when you get to that size, institutional investors. And so they could be endowment funds from universities. They could be pension funds for large corporations. They could just be sort of just large institutions, right? That just allocate capital to hedge funds. They call them fund of funds. But generally speaking, there could be sovereign wealth funds, like a sovereign wealth fund that the UAE has or that Canada has. But basically, these are large amounts of capital that need to be invested, and they're looking for opportunities that are differentiated. They're looking for less volatility potentially. Or more volatility, who knows, right? But they're generally, I'd say, for the most part, sophisticated, large cap investors. That's not to say that retail investors don't have access to it. So now a lot of retail investors have the ability to pool their capital. If, for example, they have a relationship with, let's say, like a JP Morgan or Morgan Stanley or another investment bank, these banks are offering retail investors the opportunity to invest, let's say, $100,000, and they'll pool a bunch of retail investors and they'll allocate like a large amount to one of these hedge funds. But again, they're looking for accredited investors because this is a different part of the overall investment sort of landscape, and they do really want to focus on sophisticated investors that understand the risks they're taking when they're investing in these hedge funds.
So you have to have that knowledge before, because it is a very specialized market and investment strategy.
Yeah, they want to make sure you understand the risks for sure.
What is a mutual fund and how are they different from hedge funds?
Yeah, for sure. So mutual funds typically are long only. Their fee structure is very different than hedge funds. Historically, hedge funds were charging 2 and 20, which meant 2% management fees and 20% of the profits. That has gone down dramatically, I would say, over the past few decades. And the opposite of the spectrum, you've got a lot of these multi-managers that actually have increased their fees. And investors have been willing to pay those fees because these hedge funds have delivered on the return profile on a risk-adjusted basis. So that's what's been happening on the hedge fund side. But on mutual funds, they're typically just benchmarking themselves against a specific index. Index could include like the S&P 500, top 500 companies in the S&P. Could include NASDAQ. It can include a specific sector index. And these mutual fund managers will typically take money from regular investors. They'll take money from endowment funds and pension funds. But they're basically just benchmarking themselves against this index. And these portfolio managers at the mutual funds will basically determine if they want to over-allocate or under-allocate to specific names within their index to see if they could beat the benchmark. They typically charge significantly lower fees. We're talking about 20 to 50 bips, which is, fraction of a percent. So lower cost, long only generally speaking, potentially more volatility. But over a long period of time, it has been an amazing way for investors, retail investors and institutional investors to allocate capital. And, if you look historically, the stock market has gone up, 10%, let's say on average per annum over the long cycles. So it's a really cost-effective way of investing, for low fees.
We've talked about so many of the different strategies hedge fund managers use. How do managers decide which strategies fit their skill sets?
Yeah, look, it really depends on the portfolio manager or the CIO's background, right? Ultimately, people do have their niche, their expertise. and based on the background, they pursue it. Like I mentioned, mine was event-driven because I kind of just fell into it, and that's kind of what I pursued. Ultimately, if you were, let's say you were a tech banker, getting right out of school, and that's kind of what you liked, and ultimately you ended up becoming, senior, start off as an analyst, portfolio manager, and you want to focus just on tech, or whether it's rates. My brother, for example, he trades mortgages, and then he did that for a bank for, I'd say 20 years, and then now he's a portfolio manager at Stevie Cohen's hedge fund, focusing specifically on structured products and mortgages. So it really just depends on what your background is at the end of the day. And the investors allocate their capital based on what their needs are, right? Like if I have too much exposure to stocks and I want more exposure to, let's say, rates, so then I'll change my allocation. Or I have too much exposure to one specific sector and I want more exposure, I want to diversify it, then I'll choose another manager that does something different, right? So it really depends on the needs of the investor and the background of the portfolio manager / CIO.
How has the hedge fund landscape evolved over the past 25 years?
Yeah, I'd say it's interesting. I mean, before when I started, like there were people, that they'd raise like $10 million and, they can start a hedge fund and over time they can grow into a large institution. I'd say that's very difficult to do nowadays. And there are various reasons for that. One, it's become very expensive to operate these hedge funds, right? Just from a regulatory standpoint, it is very expensive. Two, the fee structure has gone down dramatically. Historically, there was a 2 and 20 model, which basically meant 2% management fees that would cover your overhead, and then you get 20% of the profits. Because of just generally speaking in the industry, the fee compression, that no longer exists, right? So like it's, you're not generating as many fees to actually operate the business. And so you've seen that. And then you've seen this whole new emergence of these multi-manager hedge funds, right? So basically, if I wanted to start my own hedge fund, I'd have to raise all this capital. I'd have to basically invest in my people. It was very expensive. But now I can go to a multi-manager platform. They'll give me the capital. I don't need to worry about fundraising. They'll just give me $1 billion, $2 billion, $3 billion. They'll allow me to build my team so that I just have to focus on investing. And you've seen a huge transition of folks basically choosing just to go to a multi-manager because it's almost easier to start a business. Having said that, it's very different. So if you go to a multi-manager hedge fund, you have very strict risk frameworks that you need to adhere to. Those are all negotiated upfront before you join, but they're tight. So as a result, you don't have as much sort of bandwidth to take excessive risk. Like you need to minimize volatility. You have drawdown limitations. You have limitations in terms of how large your position size could be. You have limitations in terms of how much exposure you can have to a specific sector or a specific factor. So it's a lot tighter, I would say. And a lot of it has to do with the fact that these multi-managers are using a lot of leverage. Whereas historically, with these single manager funds, which means like one guy, like let's say me, wanted to start a hedge fund, I'd raise a bunch of capital, and I would give my investors an understanding of exactly how I'm going to run the business, but I would have a lot more flexibility, right? So I'd be able to be net long a lot more than I would be if I were at a multi-manager, or I can have all these different areas of investments. So for example, rather than just focusing specifically on equities, I can focus on equities and commodities and macro and private equity. Like it's just a lot more diversified. I could be, whereas, the multi-managers, like you focus on your niche and that's what you do. So it's definitely changed dramatically, I would say. It's gotten a lot more institutional over time.
More centralized.
Yes, definitely.
When you were a portfolio manager for a hedge fund, what did your typical day entail? Yeah,
so I would have, like I mentioned, I'd managed a ton of capital. So I had large teams. I'd have 6 to 9 analysts, depending on where I was. Because I was a generalist, focused on event-driven strategies, I had each analyst focused on a sector. And so I'd have 5 analysts. Each one would have a sector. Their juniors would support them. And so, typical day, I'd walk in. Obviously, I'd go over the portfolio. I read 3 newspapers a day. I'd have meetings with each one of my analysts, like a group meeting, where each one goes through the news, what's in the portfolio, what changes have occurred, and then any recommendations on whether or not we should be changing our positioning, whether, buying more, selling more, hedging, getting out of positions, you name it. We'd have those morning meetings. And then after that, I'd have individual meetings with each analyst, and we'd really delve deeply into exactly what's going on in the portfolio. And so I'd want to understand exactly where the risks lie. And during those meetings, the analysts would have the opportunity to pitch new ideas. So, for example, like not just what's in the portfolio, but hey, I've been Mullen, I've been focused on this new idea. Let's go through it. So they've already at that point written a memo for me. They've got a full financial model. Which can help me understand the risk reward profile, meaning if we're right, how much money we'd make. If we're wrong, how much money we would lose. It would have recommendations in terms of position sizing, and then also recommendations on how to hedge the position. And then if it's still early on in their due diligence phase, like what needs to occur for us to get conviction to actually initiate a position or size it up materially. And that gave me an opportunity to give my expertise and my feedback, but also really understand exactly what we're focused on from the analyst perspective. And then the days were always busy, so risk management. Looking at the overall portfolio and really figuring out where the risks lie from a factor perspective, from a drawdown perspective, making those adjustments. I spent a lot of time talking to my peers at other hedge funds, exchanging ideas. I talked to a lot of the sell side, which means the banks themselves and their research analysts, and understand exactly what they're focused on. Spent a lot of time reading, like I mentioned, at least newspapers a day, but also research reports. And, we had a lot of resources in terms of data feeds. So definitely very busy. I spent a lot of time traveling as well, going to industry conferences, meeting with management teams, understanding exactly what they're doing with their businesses to figure out exactly what areas I should be focused on, what I should not be focused on. So it was every day was different, I would say.
Did your typical day change throughout your career?
Yeah, for sure. Just because the fact that I was a generalist, every day was different. I was always learning about new companies and different themes. And so with an event, there were all these different waves. I would say there was a large wave of LBOs in the mid 2000s, and there was a large wave of companies going to overseas for tax purposes, like inversions. Then there was this whole phase where companies were converting to REITs. Then there were all these different sort of areas that always kept me busy and always learning about different things in different jurisdictions. And I had a global mandate, so I spent a lot of time in Japan, for example, a lot of time in Europe. So it's always fascinating. Each one of those jurisdictions has different rules and different sort of factors and different things happening that are creating mispriced opportunities for me to potentially take advantage of.
Well, you recently co-founded your own company called Digital Strategy. What does Digital Strategy do, and what inspired you to found the company?
Yeah, so I decided to basically pivot. I spent obviously 20 years plus on Wall Street, learned a lot, and I figured let me try to utilize the skill sets that I've sort of developed over those 2 decades and apply it to something else. I teamed up with 2 friends to essentially create a new company. I'm really excited about sort of the digital asset space, including AI and crypto. There are a lot of amazing companies that are growing, 30 to 40% per annum with amazing growth profiles. I feel like it's the next big thing over the next 2 decades, I would say. And so I want to be a pioneer and part of that sort of journey. And so the goal is to basically bring operating businesses that generate revenues, cash flows, profits with amazing growth profiles. And really showcase them to traditional investors, both institutional as well as retail. Most people don't have access to that. And so unless they're investing in venture capital firms or hedge funds. And so I'm really trying to, amass those businesses, package them up in a publicly traded vehicle and bring them to investors so they can actually benefit and participate in that growth as well.
So you're the vehicle between everyday investors and these crypto companies to invest in.
Exactly. And it's not just crypto. It's going to be also like neobanks, crypto companies, basically using the blockchain technology. And so it's not focused on like tokens and things of that nature. It's really focused on the operating businesses that support the ecosystem that really is behind all this stuff that you don't see. Like general investors can buy Bitcoin, but they don't really understand how it works and what's behind it, right? So for me to be able to actually purchase those companies wholly owned in a publicly traded vehicle with full transparency, accounting, all that good stuff, and really provide institutional and retail investors the ability to access those investments. That's the ultimate goal.
So, what does your day-to-day look like now, and what role do you play?
Yeah, it's extremely busy. I'm going to be the executive chairman. So because of the fact that it's going to be publicly traded, obviously a lot of compliance and regulatory issues that I got to deal with. So I would say my days are packed talking to lawyers, talking to bankers, talking to other advisors that are helping us out with how to deal with the SEC and the regulatory requirements there. And then it can be as basic as me looking today. I spent 30 minutes focusing on what our logo is going to be. So it's everything from the most basic things to the most complicated things. But, it's a lot of fun, learning a lot. I'm building a team, so I spend a lot of time interviewing folks and trying to, really create a team that's going to be super successful. Ultimately, super successful in creating this entity, this vision that we have that we can deliver to the public markets.
It sounds that you really do have a lot on your hands right now, but how do you spend your free time? What are some of your favorite hobbies these days?
Yeah, for sure. Very busy, but I guess you get kind of used to it, and you get to really compartmentalize your times efficiently. I have 2 boys, spend a lot of time with them, whether it's playing sports with them or engaging with them or traveling. Picked up golf recently, pickleball, tennis. So I keep myself busy.
Yeah, some great sports. So now for the question I ask every guest on my podcast. For kids in high school and college looking to enter the world of finance, what advice would you have?
I would say choose your friends wisely. It's a common saying, but your top 5 friends you're going to be a product of your environment. You're going to essentially be like them. If you engage with people that are driven, motivated, not distractions, that are like-minded, and have a great vision that's aligned with yours, you'll be successful with them. If you align yourself with people that are not necessarily as focused and have not as much ambition and things of that nature, you'll ultimately become one of them or be ultimately supporting them down the line. My biggest advice is choose your friends wisely, and then also network. You're young. Make sure you speak to as many folks that you can, whether it's professionally, academically, just from a casual friendship perspective. Just build your network, because you never know ultimately down the line as you grow where everyone's going to end up. Like, you're still very young, and the classmate that graduated 3 years ago from your high school might be an analyst at a major investment bank, and he's in charge of recruiting for your school, right? So he can introduce you. 5 years fast forward, he's now a senior associate, maybe VP, and all of a sudden you're at another bank or institution and you want to transfer and make a move. You have a contact. At the end of the day, you yourself could be in the position as a result of your networking to be able to help others out, which is just as fulfilling, if not more. So I would say just network, because over time it's like investing in the stock market. The earlier you start, the more benefits you have over, based on compounding, right? And compounding interest, I'm sure you've talked about that with some of your other guests. It's the same thing with networking. Like, that relationship grows, and ultimately down the line, like it's not gonna hurt you. It'll just benefit you at the end of the day. So you should definitely do your best to put yourself out there. Don't be afraid. Don't be scared. Engage, interact. Worst thing that people can say to you is no, thank you, right? So that's my advice. Align yourself with the good people and network.
Thank you so much for this thoughtful piece of advice and analogies. I appreciate you diving into the world of alternative investments and hedge funds. It was a pleasure to have you on the show.
Absolutely. Thanks for having me.
Thanks for listening.